Hey guys, today's video is all about index funds, mutual funds and ETF funds, and it's about which one is for you, which one should you buy. So what are the differences between these three funds? Well, mutual funds are basically a pooled investment where many people are putting their money together to make investments and then and earn money through that. Now mutual funds are managed by someone. So there's someone that has control of everyone's money there, and they're picking and choosing all the different stocks that they think will do best. And because they're doing this and that's their job, you have to pay them a fee. It's a couple of percent usually, which adds up if you invest in a lot. Of $10,000, it's a couple of $100, $200-300 there. So they get that every year, so that's something to take into account. And you have no real control over which stocks they're choosing or anything like that. They could make you lose money and you still need to pay the fees, which would be very unfortunate. Now talking about index funds now. Index funds are basically just a fund where it's just tracking the stock market. So if it's in the UK, they're typically the FTSE 100, the top 100 companies in the UK. If it's in the United States, it will be the S&P 500, the top 500 companies. And an index fund will be investing in all of those top 500 companies, for example. Different amounts in each one, and nobody's managing this. There's not someone there just picking all the different stocks and shares that they want to invest in. This is just investing in the whole stock market basically. So this has a very low risk, because even if say 10% of the companies lose money, the other 90% they'll be earning money. So the stock market's pretty much always on the increase. You'll make so around 7% growth per year with a typical index fund. Now index funds also have the benefit that they allow you to reinvest your money automatically. You can basically make like a direct debit, and you say you want to invest $500 a month, $1,000 a month. It will just automatically take that out of your account and reinvest it in there. So you don't need to actively do anything. You can just, you start investing, you put $10,000 in the fund, then you put, for example, $1,000 a month. It comes straight out of your account, and you just leave it. And there's nothing you need to do. You don't need to watch it. You just want to hold that index fund for 20 years, 30 years, and then you'll see, massive growth from that. Obviously index funds is probably my most recommended type of fund. It's the safest as far as long-term permanent growth. 7% roughly you'll be making there year on year. It's just something that's hassle-free. It's a passive income. It's completely passive, because you just once it's set up, there's nothing else to do. You just keep reinvesting and you keep making more money. And the fees, there are fees with index funds, but the fees are not the same as with mutual funds, because with mutual funds you've got someone there picking up all the different stocks and things, and I'm sure there are good ones where you can make a lot of money, but it's a lot riskier than index funds, which just track the stock market in general. So with an index fund you typically pay less than 0.1%, so it's way lower than a mutual fund. Now talking about ETFs, an ETF is basically the same as an index fund. It's pretty much exactly the same thing. The only difference is with index funds you can buy or sell once per day, and with ETFs there's all different ETFs, all different ETF funds, and they basically act like their own stock, and you can buy and sell those as many times as you want whilst the stock market's open. So you can basically trade ETF funds and things like that. One goes up, one goes down. Now issue with that is obviously it's riskier, and really if you've got your money in an index fund, or you know, an ETF, for example, you don't want to be trading that, you know, daily. There is money to be made, as with anything, if you're knowledgeable, but it's risky, you know. If you just put your money in an index fund, then it's just passive income there. You just leave it, you know, just put the money in, just forget, and it will just, you know, you can just get an automatic payment there. It will just be reinvesting all that money each month, and your amount of stocks will grow, your earnings will grow, and there's just nothing you need to do. Because when you're doing things like this, day trading is the number one way of losing all of your money very quickly, unless you're a professional and you're very knowledgeable about these kind of things. And it's extremely risky just to start day trading and buying and selling stocks and shares and things. I'm not saying don't do it. I buy individual stocks, but you should buy a couple of individual stocks, and then perhaps have the majority of your investments in an index fund. And then you can just buy 2 or 3 that you think they might do well. Invest in Tesla, or don't invest in NEO. I don't recommend that. But a company that you think's on the up, Amazon, I don't know, Apple. Apple's a good one. You can invest in a few of those, and just do a bit of buying and selling there. But the majority of your money you want to keep in an index fund, for that very safe, 7% roughly year on year growth. So that's what I recommend, index funds. I don't recommend a mutual fund at all. ETFs, but just do an index fund, because it's just so it's automated, it's easy, it's just do and forget. The true meaning of passive income, and it'll earn you money with zero effort on your part. You've just got to put that little bit of money in there, and it will make you money year on year, without fail. So give the video a like, guys. I hope it helped, and I'll see you in the next one.